Back in January 2023, Palantir was sitting near $6 per share, and almost nobody wanted to touch it. The mood around the company was brutally negative. Analysts were slashing their price targets. The stock had been falling for more than a year. The company had recently posted quarterly losses, and for many commentators, that was all the confirmation they needed to say the original investment thesis had failed. Across social media, investors were calling Palantir overvalued, overhyped, and nothing more than a government contractor pretending to be a real technology company. The retail crowd was not just doubtful, many were openly dismissing the company as a dead story. But while most people were walking away, I was buying, not because I wanted to be contrarian just for the sake of sounding different, not because I had some secret piece of information that the rest of the market could not see. I was buying because the framework I was using, the same framework I have applied through every major investment cycle I have studied and navigated, was flashing a very clear signal. The market was badly misunderstanding what Palantir actually was, what problem it was solving, and how much structural demand would emerge for its specific capability once artificial intelligence moved out of research labs and into the real operating systems of large companies. From around $6 to nearly $140 in roughly 3 years. That is about a 2,300% return for the investors who understood the thesis, built the position, and had the discipline to hold through the chaos. They had to hold through disappointing earnings quarters. They had to hold through sharp corrections where the stock fell 30% in a matter of weeks. They had to hold through every moment when the headlines made selling feel like the responsible decision. But before I explain what I am seeing today, you need to understand one thing about the Palantir thesis. It was never complicated. It did not require a complex quantitative model. It did not require access to private data. It required understanding one structural principle and then applying that principle with discipline. Find the companies building the essential infrastructure of a decade-long technological shift. Identify the layer of that infrastructure where competition is limited, where the function is mission critical, and where replacement is extremely difficult. Then hold through the noise that always comes with every major structural move. That same principle is what I am applying right now. And what it is telling me is this: the setup forming across the AI infrastructure stack is not limited to one company. It is showing up across 8 specific and identifiable layers. Structurally, this opportunity looks bigger than what I saw with Palantir in early 2023. Not because every company in this stack will copy Palantir's return, but because the scale of the opportunity, the strength of the competitive moats, and the amount of capital already committed to this build-out are larger than anything I have seen in a single investment cycle. But before that makes sense, we need to fix the biggest mistake most investors are making about AI right now. Because if you misunderstand this one point, everything else will land in the wrong place. Most investors are focused on the application layer of AI. They are looking at chatbots, generative models, consumer-facing tools, apps, and products that dominate headlines and social media. That makes sense because these are the most visible parts of the AI revolution. They are easy to understand. People can use them, test them, and talk about them. But from an investment perspective, that may be the wrong layer to focus on. Not because AI applications are worthless. They are not. Many of them are extremely valuable. But the application layer of any major technology wave is usually crowded, competitive, fast-changing, and difficult to monetize consistently. Companies fight aggressively. Products get copied quickly. Prices get pushed down. Winners are hard to predict. The better lesson comes from the California gold rush of 1849. Thousands of prospectors rushed into the Sierra Nevada hoping to find gold. But as a group, they were not the biggest winners of that economic boom. Most made very little. Many lost everything. The real fortunes were built by the people selling the tools every prospector needed. Picks, shovels, food, clothing, shelter, transport, banking, storage, infrastructure, Levi Strauss built a durable goods empire. Wells Fargo built a financial services empire. The people supplying essential infrastructure captured scalable and repeatable returns, while the miners competed brutally for uncertain rewards. The AI era is likely to follow the same pattern. Hundreds of companies are building AI applications. Competition in that layer is already intense, and it is getting worse. But the companies building the infrastructure that every AI application must rely on are in a very different position. Their revenue does not depend on guessing which chatbot wins, which software company dominates, or which consumer product becomes popular. Their revenue depends on the build-out continuing. And that build-out is not a small trend. It is a structural necessity. So now let's walk through the 8 layers of AI infrastructure where the real structural opportunity is concentrated. And I want to be specific, not vague, not hype. Specific about the dominant companies in each layer and why their positions are durable. Because this framework only works if the moats are real. The first layer is physical infrastructure, the data centers, cloud platforms, and computing environments that house everything else. These are the landlords of the AI economy. They own the land. They own the compute environments. They do not care which AI model wins. They do not care which chatbot gets the most users. Every AI company, every enterprise deploying AI, and every research institution training large models need space, compute, and cloud capacity. That is why the major cloud platforms sit in such a powerful position. The 4 companies dominating this layer are Google, Amazon, Microsoft, and Oracle. These are not simply speculative AI bets. They are infrastructure giants collecting rent from an economy that is expanding rapidly and has very few alternatives. Google Cloud has been growing at a very strong pace. Microsoft Azure continues to expand aggressively. AWS is still growing from the largest base, and its operating margins have expanded sharply over the past few years. That margin expansion is not random. It reflects the operating leverage of infrastructure businesses at scale. Once the fixed infrastructure is already built, every additional dollar of revenue becomes more profitable than the last. These companies are not just growing. They are compounding their competitive advantages as they grow. Oracle holds a particularly important and often underestimated position in this layer. Its customer base includes some of the largest enterprise organizations in the world. Many of these companies have not fully moved their data workloads to the cloud yet. That creates one of the biggest remaining migration opportunities in the cloud market. Oracle is not only competing on technology, it is competing through existing relationships, deep data integration, and decades of trust with enterprise clients. Those relationships are not easy to break. The second layer is compute. These are the engines of the AI economy. Every AI data center needs 2 core components to process workloads at scale: graphics processing units and high bandwidth memory. Without these components, data centers cannot perform the massive matrix calculations that power modern AI models. And here is the crucial point: the companies supplying these components are operating with competitive positions that range from near monopoly to actual monopoly. NVIDIA's position in AI GPUs is probably the most important moat in the entire AI infrastructure stack. But the moat is not just the chip. It is the CUDA software ecosystem. CUDA is the programming environment developers use to optimize code for NVIDIA hardware. It has been developed and refined for more than 15 years. Millions of developers have built workflows, tools, and software around NVIDIA's architecture. Switching away is not as simple as buying a different chip. It means rewriting and re-optimizing enormous amounts of code. That is expensive, time-consuming, and technically risky. This is why NVIDIA's competitive position is so powerful. The hardware is exceptional, but the software ecosystem makes the lock-in even stronger. NVIDIA is trading at roughly 24 times forward earnings, and for a company whose earnings are growing faster than its stock price, that is not automatically expensive. The real question is whether the earnings power 5 years from now is much larger than the market is currently pricing. Then there is ASML. ASML manufactures the extreme ultraviolet lithography machines required to produce the most advanced semiconductor chips in the world. These machines use light at a wavelength of around 13 nanometers to etch circuits at incredibly small scales. The science and engineering behind this took decades to develop, and no competitor has successfully replicated it. ASML is a monopoly in the literal sense. It is the only company in the world capable of manufacturing these machines at the required level. Every advanced chip manufacturer, whether it is TSMC, Samsung, or Intel, must buy from ASML if it wants to produce the most advanced nodes. There is no real alternative. TSMC, the world's leading semiconductor manufacturer, holds a similarly powerful position. The ability to manufacture chips at the most advanced nodes, such as 3 nanometers and 2 nanometers, is concentrated at TSMC in a way that cannot be quickly copied. NVIDIA, Apple, and many others depend on this manufacturing capability. Building a comparable foundry ecosystem would require enormous capital, deep expertise, and years of process development. The moat is not only technical, it is temporal. It is built on time that competitors cannot easily compress. Micron plays a different but still critical role. It supplies high bandwidth memory, the type of memory architecture AI chips need to process large volumes of data in parallel. AI workloads are data intensive, and without HBM, the compute engine cannot perform efficiently. The HBM market is an oligopoly with extremely high barriers to entry. The manufacturing process is difficult. The capital requirements are huge. Customer qualification cycles are long. Micron's focus on HBM and its positioning with major AI chip manufacturers give it a form of revenue visibility that is structural, not merely cyclical. The third layer is networking. These are the highways between compute nodes. Inside an AI data center, thousands of servers must communicate with one another at extremely high speed and with extremely low latency. The company that dominates this specific function is Arista Networks. Arista builds the switches, routers, and software that allow servers inside major data centers to communicate efficiently. Its EOS operating system is deeply embedded in the workflows of the large data centers it serves. This creates a real switching cost. Replacing Arista does not simply mean swapping one piece of hardware for another. It means redesigning network architecture, retraining operations teams, and accepting operational disruption during the transition. In most cases, the cost and risk of switching are larger than any savings a competitor could offer. Arista's financials reflect the strength of this moat. The company has around 43% operating margins, zero debt, about $11 billion in cash on the balance sheet, roughly $4.5 billion in annual free cash flow, and around $9 billion in annual revenue, growing near 30%. Those are not the numbers of a business being crushed by competition. Those are the numbers of a company with pricing power, customer loyalty, and a structural position inside the AI data center build-out. But here is what many investors get wrong about Arista. The stock has already moved significantly from its lows, so people assume the opportunity is gone. That is the wrong way to analyze a structural thesis. The question is not simply what the stock has already done. The question is what the business will be worth 5 years from now compared to the price today. A company growing revenue around 30% annually with 43% operating margins and zero debt is not automatically expensive just because the chart has already moved. The appreciation shows that the market has partially recognized the thesis. It does not necessarily mean the full value of the next decade of AI infrastructure growth has been priced in. The fourth layer is power and cooling, and this may be the most underestimated layer in the entire AI infrastructure stack. Why? Because power and cooling represent the most severe physical constraints on AI infrastructure growth. And the companies solving this problem are still in the early stages of broader institutional recognition. Modern AI compute creates a heat problem unlike anything traditional computing has dealt with before. High-density GPU clusters generate enormous amounts of heat. These are the configurations required for large-scale AI training and inference, and traditional air cooling systems are not enough to manage them efficiently. The industry is being forced to transition toward liquid cooling and direct contact thermal management systems that remove heat directly from chip surfaces at the speed modern AI workloads require. And this is not optional. It is physics. Vertiv Holdings is one of the dominant suppliers of liquid cooling and thermal management systems for high-density data centers. The clearest evidence is in its backlog. The contracted work sitting on Vertiv's books represents years of visible revenue from hyperscale operators that have already committed to building AI infrastructure requiring these products. This revenue is not based on hope, sentiment, or a consumer trend. It is contracted, committed, and scheduled. Constellation Energy addresses the power side of the same problem. AI data centers require 24-hour, weather-independent, scalable baseload power. Solar and wind can help, but they cannot provide baseload reliability on their own. Nuclear can. Constellation is the largest operator of nuclear power plants in the United States, and it is signing long-term power purchase agreements with major hyperscale operators. These contracts provide revenue visibility measured not in quarters but in decades. They are legal commitments from some of the strongest corporate balance sheets in the world. Bloom Energy provides another solution for operators that cannot wait years for grid connections or new power capacity. Bloom's on-site fuel cells generate electricity directly from natural gas and can be installed near data centers. This allows operators to bypass the grid entirely. The appeal is obvious. If a data center needs power now and the grid connection will take years, Bloom systems can potentially be deployed in months. The deals being signed between Bloom and large cloud and enterprise operators show how urgent this constraint has become. The fifth layer is the control layer. This is where Palantir lives, and this is the layer many investors misunderstand the most. Enterprise AI deployment is not mainly a technical problem. It is an operational problem. The challenge is not simply building a model that can perform a task. The challenge is integrating that model into existing enterprise data systems, business processes, regulatory frameworks, and organizational workflows in a way that produces reliable, auditable, and scalable results. Most AI applications are designed for consumers or narrow technical use cases. They are not built for large enterprises operating in regulated industries with complex data environments and strict accountability requirements. Palantir's artificial intelligence platform is designed specifically for that problem. It acts like an enterprise AI operating system. Palantir has spent around 20 years building data integration pipelines, workflow automation systems, and governance frameworks that make AI usable in environments where reliability and accountability are non-negotiable. That kind of 20-year investment cannot be copied quickly by a competitor that simply builds a chatbot. Once again, the moat is temporal. Like TSMC, the moat is built from years of engineering, implementation experience, and customer trust. The stock has fallen from recent highs, but this is the same pattern that has appeared during major corrections throughout Palantir's history. Every time investors panicked and sold during these corrections, many ended up regretting it when the business recovered and the thesis continued to play out. The core earnings trajectory has not changed. What changed is short-term sentiment. Those are not the same thing. The sixth layer is the data layer. Data is the fuel of AI. AI models are only as good as the data they are trained on and the databases that serve their queries in real-world production environments. MongoDB and Oracle both play important roles here, but in different ways. MongoDB's document-oriented architecture is especially well-suited for the unstructured and semi-structured data that AI applications often use. AI does not always deal with neat rows and columns. It deals with documents, text, images, logs, interactions, and flexible data formats. MongoDB is built for that type of data environment. Oracle, on the other hand, dominates the enterprise database world. Its advantage comes from the huge base of enterprise clients still holding decades of legacy data. As those organizations move toward cloud-native AI infrastructure, Oracle has a massive migration opportunity. The database layer may not get the same attention as chips or chatbots, but without reliable data infrastructure, enterprise AI cannot scale. The seventh layer is observability. This means monitoring, diagnostics, and real-time visibility into what is happening inside AI infrastructure. If cloud and AI systems become more complex, companies need to know what is working, what is breaking, where latency is rising, where failures are happening, and where costs are exploding. Datadog is the monitoring gold standard for cloud-native environments. The switching costs in monitoring software are among the highest in enterprise software. Changing monitoring systems requires re-instrumenting every application and service inside a company's technology stack. It requires retraining operations teams. It requires accepting a period of weaker visibility during the transition. For most organizations, that cost is simply too high. This creates loyalty that is not based on preference. It is structural. The eighth layer is security. Every AI deployment expands the attack surface of the organization using it. AI systems touch sensitive data. They make decisions. They interact with external users. They connect with internal systems. This creates new categories of security risk that traditional security architectures were not fully designed to handle. CrowdStrike and Zscaler address different but complementary dimensions of this problem. CrowdStrike protects endpoints, devices, workloads, and systems using AI-driven threat detection that can identify malicious behavior in real time. Zscaler protects access, making sure only authorized users and systems can reach sensitive AI infrastructure, regardless of where those users are physically located. The competitive positions of both companies are strengthened by the same pattern we have seen across the infrastructure stack: high switching costs, deeply embedded customer relationships, and demand that grows as AI infrastructure expands. Now let's pull back and look at the bigger point. Every company I have discussed shares one critical characteristic. Their revenue is not dependent on which AI application wins. NVIDIA does not care whether OpenAI, Anthropic, Google, or some future company builds the best model. ASML does not care which hyperscaler builds the most AI capacity. Arista does not care which software company captures the most application revenue. Vertiv does not care which data center operator grows the fastest. These companies provide the infrastructure that all participants need. They are the picks, shovels, dynamite, boots, tents, roads, and supply chains of the AI gold rush. Their revenue grows with the build-out itself, not with the outcome of the competitive battles above them. That is the key difference. This creates the type of investment opportunity I believe is most powerful across technology cycles, investing in structural necessity instead of making a competitive bet. The companies in these layers are not merely speculative bets on AI becoming popular. They are positioned around the infrastructure required to run AI, regardless of which companies dominate the application layer. That is a fundamentally different risk profile, and in many cases, a far more attractive one. The capital already committed to this build-out makes the thesis structural. Major hyperscale companies have committed hundreds of billions of dollars annually to AI infrastructure spending. These are multi-year commitments. They are already in execution. The U.S. government has committed massive spending toward grid modernization to support the power needs of the new infrastructure economy. Fortune 500 companies across almost every industry are committing multi-year budgets to AI deployment. That spending flows through the infrastructure layers we just covered. This capital is not dependent on one app going viral. It is committed to the build-out. But timing is the question everyone asks. Many investors look at the moves these stocks have already made and assume the opportunity has passed. Arista is up hundreds of percent since the thesis became visible. Nvidia is up dramatically from where earlier investors entered. Vertiv has also moved sharply in a short period. The natural reaction is to think, I am too late. That reaction's understandable, but in structural multi-year investment themes, it is often wrong. The companies discussed here are not priced for the end of the story. They are priced for a specific moment inside a build-out that could take a decade to complete. Looking at Arista's rise from its 2022 lows and assuming the opportunity is finished is similar to looking at Amazon in 2010 after it had already recovered from its post-dot-com lows and saying the cloud opportunity had been missed. But what Amazon built between 2010 and 2020 was far larger than what it had built before. The early stock move was only partial recognition of a thesis that still had years of compounding ahead. The AI infrastructure build-out is still in its early stages. The capital commitments are being made now. The infrastructure is being built now. But the revenue that flows through these companies can compound for years beyond the initial construction phase. Training, inference, enterprise deployment, application development, data management, security, monitoring, cooling, and power will all grow as the installed base expands. Peter Lynch once said, "It is never a bad time to invest in a great company." The deeper meaning is that the quality of the business and the durability of its competitive position often matter more than whether someone else bought at a lower price. The question is not whether the stock was cheaper before. The question is whether the intrinsic value of the business 5 years from now is meaningfully higher than the price you are paying today. For the monopolists and near monopolists in the most irreplaceable layers of AI infrastructure, the answer to that question appears clear. The Palantir thesis was never just about a stock that had not moved yet. It was about a business whose fundamental value was being dramatically underpriced because the market was focused on short-term losses instead of long-term structural positioning. That same principle applies across the AI infrastructure stack today. The market is often pricing these companies based on today's earnings, but the structural thesis is about what those earnings could look like 5 years from now when the AI build-out has matured, when the operational AI economy is running on the infrastructure being built today, and when the moats already visible now have been strengthened by another half-decade of customer relationships, switching costs, engineering investment, and scale. I have seen enough cycles to know this. The investors who act on structural frameworks instead of price momentum are the ones who capture returns that seem obvious in hindsight but feel invisible in the present. Palantir was visible in the data in January 2023. The difficult part was not seeing the data. The difficult part was reacting correctly when everyone else was afraid of it. The same thing is happening now. The data is visible again. The infrastructure build-out is visible. The capital commitments are visible. The moats are visible. The demand is visible. And once again, the result will not be decided by who sees the information first. It will be decided by who has the conviction to act on it before the rest of the market admits what is already happening.